The Mega Backdoor Roth is an incredible strategy to get extra money in your Roth IRA or your Roth Solo 401k. Let's talk about how to supercharge your Roth savings with this strategy. You might remember from a previous video we talked about the different types of contributions. There's employee contributions and employer contributions. As a quick refresher, employee contributions are also known as elective salary deferral contributions. They can be pre-tax or Roth. They can be 100% of your compensation, and you can put in a maximum of $20,500 for 2022 or $22,500 for 2023. On the employer side, these are called profit-sharing contributions. They're pre-tax only, and they can be 20 to 25% of your compensation, depending on your business structure. You can make a maximum contribution to your solo 401k of $61,000 for 2022, $67,500 if you're age 50 or older. And for 2023, you can make a maximum contribution of $66,000 or $73,500 if you're age 50 or older. That's a massive way to increase your retirement savings in a really short period of time. Where the Mega Backdoor Roth really comes into play is with a third type of contribution called a voluntary after-tax contribution. This is not a salary deferral contribution, and it can be 100% of your compensation up to the maximum limit. This is the type of contribution most investors use for the Mega Backdoor Roth strategy. Dan made $85,000 in his consulting business, and he decided he wanted to put some of those funds into the pre-tax bucket of his solo 401k and the remainder into the after-tax bucket to backdoor them into Roth. Dan made a $10,000 employer profit-sharing contribution, and then he did the remaining $51,000 as a voluntary after-tax contribution. That $51,000 voluntary after-tax plus the $10,000 gave him a total of $61,000 that he was able to put into his solo 401k plan. He converted the $51,000 of after-tax contributions into Roth. So in that 1 year, he was able to put $51,000 through the back door into his Roth 401k. Let's talk about the mechanics of how this actually works. By now, you've heard us say that we recommend that you have different bank or brokerage accounts for each tax classification. So you can put your pre-tax contributions in your pre-tax bank account, your after-tax contributions in your after-tax bank account, and your Roth contributions in your Roth bank account. And of course, in this situation, I'm using bank or brokerage account interchangeably. You can use either. So for Dan, he had that $10,000 employer profit-sharing contribution. He deposited those funds into his pre-tax bank account. But then remember, he also did a $51,000 voluntary after-tax contribution. So he deposited those funds into his after-tax bank account. Dan let the funds sit for a couple of days. This is so that there is documentation that this contribution was truly made to an after-tax account and that the funds sat there for a couple of days before being moved to the Roth 401k bank account. The paperwork is really simple to document this in-plan Roth conversion from after-tax to Roth funds. Just complete your in-plan Roth conversion form, which you can find in your 401k dashboard under Forms. Give a copy to your CPA and store a copy for your own records, just in case it's needed for tax purposes. Then file IRS Form 1099-R by January 31st, the year following the conversion. And we've got plenty of articles on our knowledge base at support.solo401k.com to help make this filing easy. Now, another interesting part of the Mega Backdoor Roth strategy is that you can also use this strategy to get funds not only into your Roth Solo 401k, but into your Roth IRA as well. The mechanics are really similar. It's just that last little step that's different. So all of the same rules apply as far as calculating and making your voluntary after-tax contribution. It can be up to 100% of your compensation, and you'll deposit those funds into your voluntary after-tax bank account. So it's got its own special designation of those are after-tax funds only. Then, once you make that contribution and you put the funds into your after-tax bank account, you'll simply do an in-service distribution and send a wire or an ACH from your after-tax bank account right into your Roth IRA. This is where things are a little bit different from a paperwork perspective than if you're using the Mega Backdoor Roth to put funds into your Roth solo 401k. Instead of filling out that in-plan Roth conversion form, instead you'll fill out an in-service distribution form. And basically what an in-service distribution means is that you're taking a distribution from your company retirement plan, your solo 401k, while you're still in service to your company, while you're still working for your company. And you're able to move these after-tax voluntary contributions to your Roth IRA. Then just like your in-plan Roth conversion from after-tax to your Roth solo 401k, file IRS Form 1099-R with the IRS by January 31st following the conversion. And again, make sure you're checking out our knowledge base since we've got lots of great articles on how to help you complete this strategy successfully. Now, a quick word to the wise, the Mega Backdoor Roth strategy does have a lot of moving parts. You are making these after-tax contributions, and then you're moving the funds either from the after-tax bank account to your Roth 401k bank account via in-plan Roth conversion, or you're moving the money from your after-tax bank account to your Roth IRA via the in-service distribution. There's a lot of moving parts, and it can be a bit of a complex strategy. Always work with your CPA to make sure that you are well supported. If you need a recommendation to a CPA, let us know, and we'll be here to help.